We now shift our focus from the effects of liquidation on the shareholders to the effects on the liquidating corporation itself. The general rule is that corporations recognize gains and losses as a result of making a liquidating distribution, as though the distributed property were sold to the recipient shareholder. So, to be clear, these are taxable events. Non-recognition was previously provided as part of what was known as the General Utilities Doctrine. General Utilities was a case in which the Supreme Court indicated that a corporation should not be taxed when it distributes appreciated property. This doctrine has been eliminated through legislation both for liquidating and non-liquidating distributions. But there are exceptions to this now general rule that liquidating and non-liquidating distributions are taxable. Indeed, as to appreciated corporate property, the exceptions now overwhelm the general rule, and it is nearly impossible for a corporation to get appreciated property out of corporate solution without recognizing gain. Built-in losses from distributed property in non-liquidating distributions are not recognized, only built-in gains. How do we come to this conclusion? Section 311A provides a general rule for operating distributions and redemptions that gain or loss is not recognized by the corporation. But in an all-important exception under Section 311B, if a corporation distributes appreciated property, in other words, the fair market value exceeds adjusted basis, then the corporation does recognize gain. On the other hand, the corporation does not recognize loss on the distribution of assets with built-in losses. For liquidating distributions of property, the general rule is that the corporation will recognize both gain and loss. This is not generally true for parent subliquidations, which will be covered later. And there are situations where you will not recognize loss. These are covered by Section 336D. These provisions are generally intended for situations where the shareholders might attempt to stuff the corporation with built-in loss assets. Conceptually, this would have been done by, for example, having the shareholders contribute built-in loss assets in Section 351 transactions or as contributions to capital to the corporation in anticipation of the corporation liquidating and otherwise recognizing net gains. In Section 351 transactions or in contributions to capital, Section 362A would have provided the corporation a carryover basis. In other words, the same built-in loss basis that the shareholder had. The corporation would then recognize that loss sometimes prior to liquidation, sometimes at liquidation, and the loss could then be used to offset the gains the corporation would otherwise have in liquidation. The exceptions in Section 336D were designed to eliminate these perceived abuses. Now, it should be noted that while the exceptions of 336D still exist and apply, the potential for abuse has otherwise been sharply curtailed by Section 362E, especially 362E2, which generally provides that when a shareholder transfers property with a net built-in loss to a corporation in a 351 transaction or as a contribution to capital, then the corporation will receive a fair market value basis in those assets. Presumably, Section 336D2 could still have a limited impact where a Section 362E2C election is made to shift a built-in loss from the contributing shareholder to the corporation. If so, the election should be seriously reconsidered. Turning to Problem 2, Question 1. Except as otherwise provided, assume the following facts. X is a corporation engaged in the business of drying fruits. X has assets consisting of land, a drying shed, and equipment. X's adjusted basis in the assets is 200. The fair market value of those assets is 300. X has earnings and profits of 100. A, an individual, owns 100%, 100 shares, let's say, of X. A's basis in these shares is 100. X adopts a plan of complete liquidation and distributes all assets pursuant to this plan. And in question 1, what consequences to X from the above facts? I believe these are the same facts as in the prior question, but now the focus is on X. And in answer to that question, X will have a recognized gain, a taxable gain of 100, as though it had sold the assets for a fair market value of 300. And so the amount realized would be 300 against an adjusted basis that X had in those assets of 200. X has a recognized taxable gain of 100. Also note, earnings and profits disappears. We will later consider how X pays the tax from this gain, considering that the very act which caused the tax is the transferring of all assets. In other words, we will discuss the issue of transferee liability. In question 2A, suppose instead that one of the assets has a fair market value of 110 and an adjusted basis of 10. This asset was distributed prior to liquidation, and X continues operations for some time prior to its liquidation, at which point the remaining assets are distributed. Would this change your answer? Well, the facts of question 2A raise the issue of whether the recognition to the corporation can be avoided by making an operating distribution instead of a liquidating distribution. And the answer is no, it cannot. The point being made here is that the treatment has been equalized between liquidating and non-liquidating distributions. In question 2B, suppose instead that the asset had a fair market value of 10 and an adjusted basis of 110. In other words, there's a built-in loss in the asset. Would this change your answer? Well, this is the one situation in which the treatment of liquidating and non-liquidating distributions has not been equalized as a general rule. Section 311 only provides for the recognition of gain on operating distributions of appreciated property, not losses on depreciated or built-in loss property. And so in question 2B, no loss is recognized. If the distribution were in liquidation, as in question 2C, then the loss would, as a general rule, be recognized. And so the answer to 2C, same as B, except the distribution of the asset is considered a liquidating distribution. Assume that X is widely owned, publicly traded corporation. Would this change your answer? The answer to 2C is that the loss of 100 from the asset is recognized. Note that all other gains and losses built in the X assets are also recognized for a net recognized gain of 100, which is 300 minus 200. We turn our attention to installment sale treatment. The first point here is to focus on the context and the issue being raised. The shareholder receives an installment obligation in the corporation's name from the corporation in a liquidating distribution. The shareholder will recognize the gain from the distribution under Section 331. Part of the shareholder's proceeds from the liquidation, and therefore part of the gain, typically long-term capital gain, will be from the installment obligation. Or it may be all of the proceeds are in the form of installment obligations. The issue is, when does the shareholder report the gain? So the shareholder has a long-term capital gain. When does the shareholder report that gain? At the time of receiving the installment obligation, or as the installment obligation is being paid? And the answer is that it depends. The general rule is that gain is reported at the time of distribution. But there is an exception in Section 453H, which has the following requirements. 1. If a corporation sells property after adoption of a plan of complete liquidation, but within 12 months thereafter, in exchange for an installment obligation. 2. The corporation completely liquidates within 12 months of adopting a plan of complete liquidation. And 3. The installment obligation acquired by the corporation in the liquidating sale is distributed to the shareholder. Then, the shareholder will not report proceeds on the receipt of the installment obligation, but instead, payments of the installment obligation would be treated as in exchange for the underlying stock of the shareholder. Note the rule does not apply to installment sales of the corporation's inventory, unless the sales are bulk sales. In other words, they are substantially all of the inventory is sold in one transaction to one person. This rule is designed to distinguish normal operating sales of inventory from liquidating sales. Finally, note that Section 453H is not available to an installment obligation where the liquidating corporation is publicly traded. Turning to question 3. I am not going to repeat the facts of question 3 because they are rather long and I guess you can read them on your own. So we will go through these facts as we analyze each transaction, but again, I'm not going to repeat the facts at this time. The first thing I would note is that X will be fully taxed on each of these transactions, no later than at the time of liquidation. Indeed, it occurs to me to ask why I included this question as part of the treatment to the corporation as opposed to the treatment of the shareholders, in other words, the prior part. Since I don't have a good answer to that question, I will ignore it. The real issue here then is how A is impacted. A has an adjusted basis in her stock of 100. She has an amount realized of $750 from the liquidation, consisting of the following: a $100 installment obligation from transaction 1, a $200 installment obligation from transaction 3, a $150 installment obligation from transaction 4, and cash of $300 for a total of $750. You just assume that that is what A receives after all is said and done in the facts. And so A has a gain of $650, an amount realized of $750 against a basis in the stock of 100 gives A gain of $650. When does A report this gain of $650? And in answer to that question, it is all reported, in other words, all included in income at the time of distribution, unless the distribution includes installment obligations meeting certain conditions as previously outlined. And so we need to analyze the facts of each transaction to determine the treatment. Turning now to each transaction to determine whether the transaction produces an installment obligation that will come under the 453H exception. First, transaction 1, which occurred on June 1st, 2020. X sold some inventory on the installment basis. The installment obligations for 100 are distributed to A. Are the conditions which were previously outlined met with regard to transaction 1? Well, what are those conditions? First, X must adopt a plan of liquidation and sell property within 12 months after adoption. The sale here took place before adoption, and so this installment obligation does not come within the special provisions. The second condition is that the corporation actually liquidate within 12 months of the adoption of the plan to liquidate. This condition is satisfied here. The third condition is that the installment obligation from the sale be distributed to the shareholder. Here, the installment obligation was distributed to the shareholder. But again, the first condition was not met, and so this sale falls outside of these special rules. I would also note that because the sale involved inventory, and that inventory sale was not a bulk sale, in other words, it was not a sale of substantially all inventory in one transaction to one person, that is a second reason why this first transaction would not produce an obligation that falls under Section 453H. How about the second transaction? In other words, the transaction that occurred on March 1st, 2021, in which X sold a piece of equipment. The equipment had an adjusted basis of 50 and was sold for an installment obligation with a face of 90. On June 1st, 2021, this installment obligation was sold by X for 80. Well, here the first two conditions are met, but the installment obligation was not distributed, and so the second transaction also falls outside of 453H. How about the third transaction? In other words, the transaction that occurred on July 1st, 2021, in which X sold a piece of equipment for an installment obligation of 200. The equipment had an adjusted basis of 150, X distributes the installment obligation to A. Well, all the conditions are met here. The sale is within 12 months of a plan to liquidate. The corporation, in fact, liquidates within 12 months, and the installment obligation is distributed to the shareholder, and therefore Section 453H applies to the installment obligation from the third transaction. How about the fourth transaction? In other words, the transaction that occurred on August 1st, 2021, in which X sold its remaining inventory to a third party for $150. The cost of that inventory was $50. The sale was for an installment obligation which was distributed to A. Does that qualify? Well, are there any facts to indicate a different analysis? Well, again, remember that there are special rules for inventory. Substantially all inventory must be sold in one transaction to one person. Here, all of the remaining inventory was sold to one person in one transaction. And so this further condition is met, as well as the three main conditions. And so Section 453H also applies to this installment obligation, meaning that Section 453H applies as to 350 of the installment obligations. So of the total installment obligations, 350 will come under Section 453H. Now that we have determined that two of the installment obligations will be treated under Section 453H, what exactly is that treatment? From the shareholder's perspective, the liquidation will be treated under the installment method. Reg 1.453-11 would accordingly provide the following results. The sales price is $750, the profit is $650, the gross profit percentage is 86 2/3%. So 650 divided by 750 is 86 2/3%. That gross profit percentage then gets applied to each amount received. The amount realized at distribution is $400. Note that the total amount realized we calculated before was $750. $350 are in obligations that qualify under 453H, and so the remaining $400 is the amount realized at distribution. You multiply that by 86 2/3%, and A will have a gain at liquidation of 346.67. So again, 400 multiplied by 86 2/3% is 346.67, which again is A's gain at the time of liquidation. The amount realized from the qualifying installments again was 350, multiplied by the gross profit percentage of 86 2/3%, means that the A will have gain reported as the installments are paid of 303.33. So again, 350 times 86 2/3% is 303.33. That is the amount of gain that A will report as the installments are paid, or as A receives payment from those installment obligations. And to show that this reconciles, again, at the time of liquidation, A has a gain of 346.67. As the installments are collected, A will have a gain of 303.33. This adds up to a total gain of 650, which is consistent with what we calculated previously. In question 4, A, an individual, owns 100% of X Corp with an adjusted basis of 100. X has cash of 100 and a building with an adjusted basis of 50 and fair market value of 100. X negotiates for the sale of the building to a third party and reaches agreement with this third party. At the last minute, X instead distributes in liquidation the building to A, who immediately sells the building to the same third party. Assume that X had a 21% tax rate. What consequence to A and X? Compare the results between where X sells the building and then liquidates, as opposed to where X first liquidates, distributing the building, and A then sells the building. Well, the facts of question 4 are intended to mirror the facts of a case called Court Holding. Court Holding is a 1945 Supreme Court case. The case used to be one of the most important cases of all of Subchapter C. The case still stands for the proposition that transactions of the shareholder can be attributed to the corporation if the corporation has had sufficient involvement in the transaction. More particularly, where the corporation has negotiated and has in substance otherwise sold corporate property, but the corporation has, prior to actual sale, distributed the property and the shareholder follows through on the sale previously arranged by the corporation, then the sale will be treated as having been made by the corporation. And so here, X will be treated as having sold the building and distributed the proceeds to A. X will pay a tax of $10.50 on the gain of $50, leaving $89.50 of cash to be distributed to A for a total distribution of $189.50. A will therefore have a gain of $89.50. What result if X is not treated as having sold the property pursuant to court holding? And the answer is that exactly the same results. You should note that court holding was decided at a time when a corporation would not pay tax if it distributed an appreciated asset. As we have considered, that is no longer true. Pursuant to Section 336, X will nonetheless be treated as having sold the property not to the third party, but to the shareholder in the case of a liquidation. And so the importance of court holding has been largely diminished. But there is still the underlying principle that the results of the shareholders can be attributed to the corporation if the corporation is sufficiently involved in what is within the scope of corporate business. How does the corporation become involved in a transaction? Well, it does it through its officers and employees. There's another case, however, which indicates that shareholder results will not be attributed to the corporation if the persons doing the negotiation are acting in their capacity as shareholders rather than as officers or employees of the corporation. This is the Cumberland Public Service case. The distinction between these two cases can be fine. After all, especially in a closely held situation, there might be a few or perhaps even just one individual acting on behalf of both the corporation and the shareholder or shareholders. How can one really discern whether that few or even one person is acting on behalf of the person, him or herself, versus the corporation, especially if that person is also the majority shareholder? And the importance of these authorities is now is the general issue of when actions or results can be attributed back to the corporation. Finally, we turn to other considerations in liquidations. First, can a liquidating corporation deduct expenditures that occur in a liquidation? The basic rule of thumb here appears to be that, except to the extent that expenditures create a long-term benefit that can be distributed to shareholders, the corporation can deduct expenditures that occur from a liquidation. This follows largely from the central premise of Section 336 that the liquidation is in essence a final reconciliation of the corporation. Any built-in gains and losses are picked up at the corporate level at that time. The last issue to consider is transferee liability. If we go back to the facts of question 1, the corporation had assets consisting of only property, plant, and equipment. It distributed those assets in liquidation. That distribution gave rise to a taxable gain at the corporate level, which therefore presumably gives rise to a tax liability owed by the corporation. Let's say a tax liability of 21. This then raises the question, who pays this liability? At the juncture that the gain occurs, and certainly by the time any corporate return would be filed, the corporation has no assets with which to pay the liability. Indeed, it is the act of distributing the assets that simultaneously creates a tax liability and depletes the corporate wherewithal to pay that liability. And you'll recall the general corporate law principles provide for limited liability, that shareholders are generally not liable for corporate debt. And so does this mean that the parties can avoid the tax from corporate level gains in liquidation by simply distributing all the corporate assets. Well, as one might expect, that approach is much too simplistic. Section 6901A1ai provides that the government has the authority to impose and collect tax liabilities from a transferee of assets where that liability exists at law or in equity. Furthermore, note that Reg. Section 301.6901-1b, so again 301.6901-1b, includes a shareholder of a dissolved corporation within the definition of a transferee. But again, note the government can go against a shareholder where the transferee liability exists at law or in equity. And so the meaning of this clause becomes critical. An explanation of the historical distinction between courts of law and courts of equity is beyond the scope of this course. But a few major points can be made here. The first is that while corporate law does generally provide shareholders limited liability, there is another corporate law principle that precludes a corporation from making distributions that would render the corporation unable to pay its claims. And if the corporation nonetheless distributes excessive assets, the shareholders can be forced to pay back those assets. And so, generally speaking, there are principles that would require the shareholder to pay the taxes in these circumstances. But a second point is that the determination is not automatic. The government must, in essence, jump over the hurdle of establishing the non-tax law principle that indicates that the shareholder is liable. And under some circumstances, for example, where the corporation and shareholder reasonably believe that the corporation could in fact pay all of its liabilities, including any anticipated tax liabilities, this obstacle could prove formidable. I would also note in this regard there is a series of recent cases in this area. The typical pattern of these cases is that a corporation closely held is contemplating liquidation. Before it does, a third party approaches them and offers to buy the corporation's stock for more than what the shareholders would end up with had the corporation simply liquidated. If the shareholders asked how this third party could pay more, the third party might just say something to the effect of, well, let us worry about that. And then after acquiring the corporation's stock, the third party would then liquidate the corporation without paying the corporation's tax. In essence, the third party would simply disappear, leaving the IRS holding the bag for unpaid taxes. In these contexts, the corporation would go against the original shareholders for the unpaid corporate taxes. The courts have accepted the government argument that in these circumstances, the shareholders were required to do due diligence, that the purchasers had the wherewithal and intention to pay the corporation's taxes, that the shareholders could not simply close their eyes to what the purchasers might do.